Welcome back for the part 3, last part of this fundamental sort of webinars series. We talked about what is the dollar index, how we can use it on a daily basis to trade with pairs against the dollar for gold, which is a safe haven precious metal, or to, for example, euro dollar, which is a directly linked currency of the dollar index. So we know now, we understand that the dollar index is comprised of the euro. So it's not like the dollar can predict the euro USD movement, but we know that at price points that I showed you on the gold, if we see that dollar is moving against not against, is moving above PSA of his PSAs, and we see that at the same time euro dollar is moving below a key level or a PSA, we have further confirmation that it is a good opportunity, good trade, a good confluence of information for us to trade with. So what we're going to do now is this. Do we have other instruments or indices or anything else that we can use as a tool to measure and to have an idea of how is the dollar right now? What is the sentiment? What is the state of in the market of the dollar? So the main instrument that we use, and I use and I learn how to use, I don't use them every day, I don't use them consistently, are the US 30, US Wall Street 30, which I showed you here. What is the Dow Jones average of 30 large, well-known US company listed in the New York Stock Exchange. So it's an index. There are many indices of the stock market, but this is about the stock market strength or weakness, as you can see here. So this is the stock market. The financial crisis bounced when they bought the dip with stimulus and increased supply of the dollar. And again, 2020, the huge drop with the COVID, and then again, with the stimulus, the continuation up. So you have to understand the fundamentals of the stock market as well. You have to understand why this stock market is moving up during crisis, while the US dollar, as I showed you before, is very bearish. So you know that the stimulus provided by the Federal Reserve of America is going directly into the stock market and into the stimulus to the government. So there are different ways. I'm not an economist. I can give you a link and we give you my notes about a very nice link of how the economy works. The Federal Reserve prints money and can give it in two ways to the government. It can buy bonds, it can buy, it can pool it. If it buys government bond, then the government has liquidity to provide the stimulus to the population. If it directly pools its money buying assets of the stock market, then of course you see that the stock market in this index and the S&P 500, many other different indices, is bullish, is going bullish. That's what happened, and that's why the stock market is always bullish, because when the Fed announces that the stimulus, then you see that move is still going up. As you can see now, still bullish, still making new all-time highs every day, every week. We're going to see a pullback probably when the tapering will be announced, because the tapering is exactly the opposite. It's saying that the stimulus is going to be cut. So we are not putting the same amount of money every month into the stock markets, and of course we're going to see a pullback, but at some price point, 33, 30K, we're going to see a bounce up again. And this, how can we use this instrument on a daily basis? This is pretty much good confluence. We also use it for example, the UK currency. This is for the US economy. Also use it for the UK. We use the UK 100, and you see the drop, and then bullish. We're sitting not above previous highs, pre-pandemic highs, as it is on the US dollar, because the stimulus of the UK was not as strong. The printing of the money is not as strong as it was of the Federal Reserve. So, but anyway, pretty quickly, if on a daily basis, on the hourly time frame, on the 5-minute time frame, you see that the price point, that the overall trend is bullish of the day, and maybe you are trading here, you just saw this range, these price points. As you can see, the price action is similar all over. You see price points and reaction at the same price points again. And you see this bounce, you see this bounce, you see this bounce, you see a double bottom, and then this nice candle that someone showed you in every backtesting session. Then you see, okay, I have more confidence that the risk is on the table. So investors are willing to put their money into the stock market instead of out of it. So they are willing to risk. So if you have a risk on market, you have the US dollar, which is the safe haven, might be bearish. So this is late night, okay? But the point is, let's see if on the Saturday, this is when the dollar was as well very bearish, was bouncing off the key level, and the US dollar was strong and bullish because the investors are not in this moment scared. There's no fear, uncertainty, and doubt. So the risk is on. They want to risk. They put money in risky assets. That's it. This is a confidence because, of course, as I told you, we have pairs that are risky and pairs that are safe havens. So if you trade euro dollar, you know that there is a risk currency against a safe haven. If you trade GBP JPY, you know that there is a risk currency against a safe haven. If you trade Bitcoin, you know it's a risky asset. If you trade GBP USD, risky currency against a safe haven. So if you see that the stock market is bullish, then you can again translate this in a possible bullish action on GBP. Because if investor globally stock markets are bullish, then you can have further confirmation that not the GBP is strong, but the USD is weak because the role of safe haven is less valuable, it's less strong, it's weaker in that moment. And this is for the US or any other US 30, any other index about the stock market. Another tool which is very useful for gold mainly is the VIX. VIX is the volatility index of the S&P 500 index. So this measures how much the investors are pulling the money out or in the stock markets. So this is for exactly the S&P 500 index. When we had the spikes mean that people are pulling out money from the stock. So the stock is bearish. What does it mean? It means that there's fear in the market because people are pulling out the money. This is exactly when people are pulling out money of the stock market. So a spike in the VIX means that there's fear, uncertainty, and doubt in the markets. Like we can see here during the pandemic. Look how many people pulled money out of the market, which was shown you into the sell-off of here, also in this US 30. This is very critical because this is exactly what happens. It's very relatable to gold. If people put money out of the market, means that the risk is off. They don't want to risk their money. The sentiment is much on the safer side. They are risk averse. That means that people can pull money into gold instead of, as you can see here, pull money into gold instead of putting it into risky assets. As you can see, the rally from 1500 to 2000, as you can see, 2000. This is exactly the same, and this is a very nice correlation to have a look at it during the day when you are trading, especially gold or other pairs. You see, okay, oh, wow, the VIX is falling down, and I already showed you, VIX is falling down at the same time. If you go on the US 30, the US 30 is going up. So you see the correlation is perfect because this is exactly the sell-off from the stock market. Another tool that you can use is the US government bonds 10-year yield. So I'm not going to give you a lesson because I'm the worst in teaching these things, but the yield on the bonds, especially during the 10 years, 30 years, 5 years, is crucial of exposing the state of the economy. If the yield are higher, then the economy is in a good point. The dollar is strong because the economy can give you is giving you more money for every bond that you purchase from the government. If the yield is instead weak, as it was during all the pandemic, as you can see here, during the pandemic was very, very, very weak and bearish, going below almost 0.5, starting from over 1.5, which is sort of like the US dollar. Of course, this is much different than, it's not that simple, not that binary as the US dollar, as everything, because there are much more correlations. But as you can see here, the same drop happened and the same drop happened. And now a slow recovery is happening as a slow recovery on the US dollar. So it's a nice correlation and confluence to give you a much better idea of, okay, are these bearish, are these bullish, how are these, how is the yield right now? Yesterday was good and the US 30 was good. I don't know the exact correlation. I use it on with the corner of my eye to see if there's some further confirmation of bullish action, of strength in the dollar. But that's it. Not use, I don't understand that well the bond market, so I'm not using it as a real confluence factor. I use mainly the dollar index, US 30, and the VIX, of course. That's the same can be used for the yen. The same can be done for the UK. Also, the UK has its own index. The yen, when the yen is closed during London session, I use euro and USD against it to see the trend. If it's the same, you see the drop. So I use them as a confluence. I hope you guys understood somewhat better, and let me know